All right, John Netto, independent trader and author of The Global Macro Edge. Welcome.
Thank you.
To RealVision.
It's great to be here.
Thanks for coming. We've been talking about doing this for a while, and I'm excited to sit and chat with you. And what I really want to start off with is your background and, more importantly, a journey you've made to the point you're today, because I think it's quite important to inform the discussion.
It is. I have been, I think like a lot of us in terms of our trading styles and how we go about looking at the markets and investing in the markets, my journey probably started when I was 8 years old and I placed my first sports bet. And just that desire to speculate, the adrenaline, the intellectual rigor that came from that got me going. Ultimately, I ran a gambling operation in high school. As I say euphemistically, I provided liquidity for those wishing to prognosticate on the outcome of sporting events. And that brought with it actually a lot of lessons I talk about in the book, which ultimately shaped my journey. One of the lessons in there which has had a profound impact in terms of how we structured the book was, here in the US, I know that betting is legal and much more mainstream in the UK, but here in the US, we work on a point spread basis, where if the San Francisco 49ers play the New York Giants, the Niners would be a 7-point favorite in the game, which means they have to win by 8 or more for one side to win, or if they won by 6 or less for the other side to lose. Well, it was a very binary outcome. So in high school, I invented what was called the progressive point spread. And what that meant is that based on the degree of win on the point spread, that's what I would pay my client. So typically you'd pay $1.10 to win $1, $1.10 gives you $2.10, etc. But it was that context that was lacking. So when we talk about the global macro edge, maximizing return punitive risk, it's the ability to apply another level of context to strategies, to the market, to a portfolio manager. And that journey for me, at least taking that perspective, goes all the way back to my days of being a bookie in high school.
Sure. Yeah, but it's funny you say that. Incidentally, what was the first bet? What was that bet?
It was on the Dallas Cowboys, and I lost. Yeah, it was 25 cents. And I bet with a classmate, and I remember the adrenaline I had from that was just so I think I'm genetically predisposed to take on risk.
Well, that's one of those things, though, that it's an interesting point, because some people have that in them, and some people don't. And it's funny when you look at the different ways to invest, and even people who are hardcore investors, there's still that trading mentality versus that investing mentality. So when you came up with this new system, in the UK we've had spread betting forever.
Sure.
Was it similar to spread betting, or?
Spread betting, there are nuances to it with spread betting that are different with this progressive point spread. One thing, it was capped. Okay, so in other words, your $1.10 would cap off at $2. But again, it was meant to provide that context in a similar way that spread betting does as well. So if the Niners were to win by 10 as a 7-point favorite, you wouldn't win your full amount, but you'd win 2/3 of your bet. Okay. Whereas if you lost, you'd still lose 2/3 of your bet as well.
Yeah. So I'm always fascinated. The nexus of investing in sports is a real fascination for me, and I find there are so many parallels between the two. What took you from wagering on sports games with your buddies in high school to getting into investing?
Phenomenal question, and without a doubt, ironically, it was Oliver Stone's movie Wall Street when I was 12 years old. And I think a lot of us out there, those of us in our 40s and 50s of this generation, there was something about watching Martin Sheen and Gordon Gekko and Michael Douglas and all of the gamesmanship, the Machiavellian aspects to how they interacted with each other, and just seeing the excitement, seeing that lifestyle, the glorified life back then. I guess those were finance gangsters, if you will, for those of us growing up in the 80s. And just watching, just that adrenaline, that rush that I got from watching the movie, I knew at that point in time at the age of 12, watching Gordon Gekko and Blue Star Airlines and everything else, that I was going to be a trader.
And so let's talk about, because that's a lot of people think that's what I'm going to do. How do you end up getting into that? Well, because it's not something you can just walk into.
No, it's something that again, taking a more circuitous route like I did, having been a bookie in high school without knowing it, I was reading Investor's Business Daily. With my Wall Street Journal subscription came a book on options. I think it's called The Story on Options, and I started studying about derivatives and other things like that. But again, really being an odds maker in high school and creating point spreads and facilitating order flow, understanding liquidity risk, event risk. I'd made a lot of money as a bookie the first 3 years, and then the weekend before I turned 18 was near Thanksgiving weekend of 1992. And I don't know in the UK, but in the US, a lot of people like to bet on favorites, and they like to bet parlay cards. Well, that Thanksgiving weekend of 1992, before I turned 18, a number of 5 and 6 and 7 team parlay cards cashed. and wipe me out, okay? I did nothing to hedge my tail risk, so that was the ultimate black swan event for me as a bookie in high school.
Okay, so let's talk about how you deal with that, because it's tough enough to deal with that as an investor that sees something go wrong. As a 17-year-old high school kid, how do you, because you know the normal response you would expect from a 17-year-old is, this is unfair, and you know, how did you deal with that?
I borrowed money, loan sharks, made sure that I was there to provide liquidity so that the people who won the bets from me all got paid. And I learned a lesson from that. It actually took me some of my time after I joined the Marine Corps to pay those back. But I learned at an early age that when adversity comes your way, you just find a way to get through it. And that skill set, because I joined the Marine Corps right out of high school, to like have that tenacity to find a way to survive. And if you can't find enough reason for someone to help you, you just create a more compelling reason. You find a way that you can provide value and know the right people to provide value to. I'd say that two things that I've been very fortunate at is identifying talent and then understanding how to provide value in those relationships.
Yeah.
If you could do those two things, you can really do well on Wall Street because you build yourself a network of people that have diverse backgrounds, diverse perspectives, and diverse processes that can ultimately benefit you.
Yeah, I mean, look, there's nowhere that is a more two-way street than Wall Street. And if you are only traveling in one direction, you get found out pretty quickly. I've seen that
very
many
quickly
times in my career. So let's get on to the book and talk about the journey, because this is something you spent a long time writing. What was it that made you want to write the book, and talk about the sort of the impetus behind it?
Sure, the book started off, innocently enough, as a follow-up to my first book from 12 years ago to put together a number of strategies about the macro space and you know, relative value, mean reversion, trend following momentum, and to build
But why macro, if I can ask? Because you're not thinking about the macro.
Your
background, especially sports, there is no macro, right?
Sure.
This is one team against the other on the day. So what was it that led you to macro?
It was the idea that I began as a technical trader, and I think that's the right way for most people to begin, because price action really doesn't lie. And if you operate on that perspective, whether you believe that or not, or whether that's the case or not, if you operate under the perspective that price action doesn't lie, you keep yourself out of a lot of jams, out of a lot of trouble, because you rely on the technicals. But that only got me so far in my career. I needed to be able to get the context, and macro was that context. And really, the definition of macro for me, I think, and for a lot of people, has materially changed in the last 20 years. What macro meant 20 or 25 years ago had a completely different risk profile than what it does today. Because of social media, because of the internet, because of the preponderance of information out there, macro and everyday trading are almost synonymous terms right now. Because that narrative of what happens in China is now processed by the time it gets to Europe, as we saw 2 nights ago, and then ultimately processed by the time it gets to the US and worked into our gap. The overnight futures trading, the liquidity of those markets, all of these microstructures have changed what macro means, so that the macro narrative or the news or the themes that are driving trades are now known by a lot more people because the information gap has closed considerably.
Yeah, you know, I find this information, it's an interesting point, because there is so much information out there, and you can make macro as broad or as narrow as you want to now. I mean, you can factor in pretty much anything, and if you can drive yourself crazy trying to corral enough information to give yourself a satisfactory macro picture when
Absolutely.
You could probably drill it down. So you've come to this conclusion that you need to understand the macro, but it's still a big leap from that to writing a book based around macro for someone with your background.
And I would say that it's more than just about writing a book about macro. It developed into a book about macro.
Yeah.
It was a strategy, and I didn't mean to misspeak earlier, it began as very basically as a book to compile more advanced trading strategies. It then, over the 5-year period, took on a macro perspective. The original title, there were 8 different titles for the book. The original title for the book was Advanced Trading Strategies. Just simple as that. Then it became The Protean Trader. Then it became The Global Macro Edge. Because to me, and the way that I trade the markets as a practitioner, is the global macro edge is the ability to allocate to robust trading strategies based on their probability of success in the current market regime. The global macro edge is identifying what the current market regime is and then leveraging those strategies accordingly.
So let's talk about the framework of the book, and let's talk about some of those points, some of those lessons that you learned as you went through it? Because this took you a long time to write. This is a Herculean effort you put in.
5 years, 3,000 hours, 200 weekends, 17 trips.
Not that you're counting.
Not that I'm counting, and going higher still. So listen, there's a lot of information out there, and there are a lot of great books going back the last 20 years, beginning with Jack Schwager and the Market Wizards books, that begin to unveil various aspects of trading strategies from great macro managers and great equity managers, long, short, relative value, etc. And that transition point, where those literary works have gone between Sebastian Mallaby, Stephen Drobny, like I said, Jack Schwager, really helped a lot of us out there get a better understanding. So when I went to the contributing authors, I said, listen, I have this real world experience. I'm not a fund manager. I can write I don't have the same constraints as a fund manager does to write a book, okay? I don't have the compliance constraints. I don't have the fiduciary constraints, the IP constraints, etc. So let's write a book that builds on what our predecessors have done, okay? Let's write a book that caters to an audience that believes in self-empowerment through self-education, that gives them actual processes along with great anecdotes so that they can move forward and really benefit in the market and understand, hey, listen, with the right time frame, and that's important, the right discipline and right processes, I can materially change my life over time. And this is an image that resonated with the Raoul Pauls out there, Bob Savage, Neil Azus, Jason Roney, these people that benefited from these previous works I've just mentioned, but wanted to give real processes that people could use going forward to experience the same success that they have had. And I think when you look at the success of RealVision, that's just a sign of how hungry people are for this kind of knowledge.
Yeah, I mean, that's something we found which wasn't altogether a surprise to us, but the hunger and the desire for that knowledge and that understanding, I think it caught even Raoul and I by surprise. You know, we figured that it was out there, but it's fantastic to see that people are so keen on trying to find out more. But what we've found as we've gone through this is, you know, we've learned an awful lot along the way. We both happily admit we came into this knowing nothing about what we were doing.
Amen.
So as you went through the book, how did you find that your own investment style changed based on what you learned from the people you spoke to?
Considerably. The thing about this, though, was that, and this was another thing we wanted to change, we wanted to address, is that we wanted to show that this was a book by market practitioners.
Yeah.
And the first thing we wanted to do was establish credibility, because this is a 580-page book. It took 5 years to write. And with so many books out in the market, with so much information out there, what's going to compel someone to read my book or any other book? Okay, and there's a few factors in that, and then I'll circle back to the structure of the book and why I think it meets those factors. The first, like we talked about earlier, is the person sharing this with me, or the group of people sharing this with me, constrained by anything, okay? And it's probably fair that RealVision people ask that as well, that when they come on and see you and Raoul doing what you do, they realize this is coming from a place of authenticity. You guys are genuinely putting your hearts out there, bringing various guests on, getting lots of information. So this is the first check in the box. The second, with these methodologies, is, are they being used in the market today? Okay, are they practical? Can they be used in the market? Can they be assimilated in there? And then third, is this person successful? And so we wanted to make sure that all those boxes were checked to the point that we said, okay, I've used this on a walk-forward basis to succeed in the markets, and it was under that structure of, all right, first thing that was essential for that success was identifying the market regime. The second was understanding what strategies to put in place. And the third was how to actually implement those strategies. And so when I went to the contributors, you had to fill one of those pockets. Raoul Pal filled the pocket of regime recognition. And his chapter is called Identifying Inflection Points in the Business Cycle. Now, we all know Raoul is a master of the business cycle. So it's only appropriate that if you can't understand where we are in the business cycle, you can have a great technical trading strategy, but guess what? If we hit an inflection point in the business cycle, your mean reversion strategy is now going to be selling tops in a market that's repricing itself. So the global macro edge, as Raoul talks about in his chapter, is about understanding when we may be in repricings based on inflection points in the business cycle, which is incredibly invaluable. And it was from that perspective we tried to structure this book around, to answer your question.
Well, it's interesting. You know, there's a couple of things there that fascinate me. The first is this idea of successful. And that to me is something I've been fascinated by as we've gone through this project, because success you can define on any time frame you want,
sure.
right? And there are a bunch of guys who've been successful for decades,
right?
And there are guys who have the overnight success, the guy that got the trade sure. right last year, for sure. example. And what I've been fascinated by as we've gone through this process is how people with decades of success have struggled for a year or two in the last couple of years, trying to get everything right and getting everything wrong. Yeah. And secondly is the response to that from investors who are very quick to write people off who've had a bad year. The whole "what have you done for me lately?"
It's amazing.
It is amazing. And so when I look at your book and some of the concepts you talk about, these are long-term strategies. And success to me is proven over years and is something that everybody has a bad year, particularly
Absolutely.
now. So how have you seen the environment that we're in now, which has made a lot of really smart people look very foolish? Publishing the book when you have, that must have been a real pull against what you were doing.
I think there's never been great question, and I think there's never been a better time to publish this book than right now. Because I feel, based on what's happened in the last few years, and the contributors feel this way as well, that there's never been more opportunity than we see in the markets today. Especially more opportunity to a more diverse group of people. The fact that I, as a trader, can sit in my living room, okay, and trade the markets on a Bloomberg terminal, on a CQG terminal, with my capital, and be as effective and have the same access to information that the guy who basically runs a $1 billion hedge fund does. And now it's up to me to how well I process that. The playing field has really never been as close as it is today. And so the idea that you can go from, with a proven process and the right knowledge and the right education, tells me that this is the time to get in the market. And let's face it, we have dealt with a very challenging market environment, and it's a market environment that by having different strategies to look at things where you can be more tactical. And let's face it, implied volatility or realized volatility has been way down, but you can be more tactical in this environment, and that's helped guys like myself who have been able to adapt working as a team. And so I think if you've been able to work as a team in this environment, employ different strategies, you get the track record like we talk about in the book.
But look, I agree with you about this leveling of the playing field. I think that's absolutely true. It's crucial to understand that. But when you kind of take a step back from that,
sure.
and you look at the outside forces that are going back to round the business cycle, that
sure.
are pulling the business cycle and actively trying to extend that cycle
sure.
and not allow
sure.
the downward half it to happen.
Sure.
It's at that point it becomes really, really tricky for people who have all the information, maybe not the experience, and maybe not having the experience is a boon rather than a problem. But I see it's a really tough time for people to be trading markets, and getting lessons from people is a great idea always, I think.
Sure.
My worry is that people say, hey, such and such a lesson didn't work. Because you know what? It might not have worked last year.
It may not have worked.
Exactly right. So how do you deal with that particular problem?
So let's talk about then, because you bring up a great point about the regime we're in right now, okay? And one thing that I do and I talk about in the book is I keep a strategy grid up, okay? And I'm very detailed, and I track dozens upon dozens of internal strategies that I've created, because those strategy boards that measure performance on a return per unit of risk basis are critical to telling me which strategy to use, which strategy is successful and which strategy is not. So let me give you an example. This is very important, okay? In 2015, all right, one of the best performing strategies in my basket, and this is really counterintuitive, but if you think about it, this is how you have to think. You have to be protein. You have to be dynamic. And tough market environments create opportunity. But the strategy one of the best strategies was long gamma short vol. And what I mean by that is this, is that you could be long front weekly options on the S&P and be short monthly options on the S&P, and the gamma on those front month options was amazing, okay? Yet, factually, the net change over the monthly ranges of the S&P was absolutely nothing, all right? And this dynamic was caused by a number of factors, but for simplicity's sake, let's just say misinterpretation of central bank communication, certain economic aspects, ECB, whatever you have, but you would get incredibly cheap front week optionality, and you can hedge yourself by selling back week optionality. Now, that's easy for me to say in hindsight right now, but this was something that triggered on my strategy grid, and was something that helped contribute to part of the success of the track record you see from 2015, okay? Now, 2016, that dynamic changed, all right? And again, this is where by having premium selling, mean reversion, and again, I'm primarily a long vol, long gamma, asymmetrical bet type of guy, but having some type of mean reversion strategy and being aware of the global macro catalysts that can change you out of that current regime should only help dampen that volatility. Now, I imagine a lot of macro funds do that, but my whole idea is you build multiple non-correlated strategies, you keep a very close watch of what the macro narratives are, market positioning. You know, Raul brought up a great point when I had a chance to meet him 4 years ago about a lot of people were frustrated over why the euro wouldn't sell down from 140 down to 110. And the market was simply too short. So one of my strategies is actually playing what I call market position premium, where I mathematically figure out how a market will react to a central bank meeting, ECB, Fed, BOE, whatever the case may be. What's the market factoring in? How's it playing? What's the optionality behind that event? And what sort of asymmetries exist that I could take advantage of? And these are situations and opportunities that do exist today, Grant. They are around today. It's about understanding the changing market microstructures to be able to capitalize on them.
But volatility is a great subject to talk about because it's human nature to want to be long volatility, right?
Yeah.
The world is volatile.
Sure.
Humans are volatile.
Sure.
So everything would scream at you, okay, I want to run everything from a long vol strategy. That hasn't worked, right? Tactically, potentially, but I'm talking about over the last 3 years in an increasingly volatile world where you would expect to see rising volatility or maybe consistently slightly elevated volatility. It's getting crushed and crushed and crushed and crushed. So how do people go about reconciling those two dynamics? Because it's tough.
You're absolutely right. Long vol and hold has not worked. And again, this is where you get into more of a market timing perspective that now we go down this rabbit hole that's very hard to quantify or justify, okay? And I would say this, most of my gains in the last 6 years, and just so we're all on the same apples to apples basis here, it was very important for me and the contributing authors that the lead author of this book have transparency over my own track record, okay? To have a book like this before people invested the time and resources would not be fair to anyone without doing that. So I hired a CPA to come in, and one of the few books I know that's ever done this, and had them come and audit my 6-year track record from the beginning of 2010 up until the end of 2015, 72 months. During this time, I took a risk budget in my own account of $100,000, trading at $1 million trading level, and generated $3.1 million in commissions on it. I hired Michael Coglianese, he's a CPA out of Chicago. He audits a number of CTAs, CPOs. We went with 4.35 rule, which is a CFTC regulation. Bottom line is I'm saying this from a guy who's made money, who's had these performances verified by a third-party CPA. This is what I did to make that money. Sure. So that's the context here, okay? Now, the biggest thing that I would say that helped me was market positioning and trading the macro narrative, okay? And then working short-term trade structures. Putting on long-term macro bets with the central bank put out there just did not seem like a conducive strategy to me. And because I didn't have the same balance sheet constraints, I'm creating my own capital, I'm not running $1 billion balance sheet marketed under a way that I'm gonna make these big macro bets. I didn't have any obligation to anyone. My obligation is, what's going on this week? Okay, vol's priced a little rich, fine. Let's sell a little bit of vol. We have a situation set up here where the market's not pricing gamma correctly, which is not something a lot of people actually price. It's simply, if you look at most vol models out there, it's high-low net change, okay? That's, well, I want to price vol for the next week, okay? Let's look at the implied volatility out there. Let's look at the past history, high-low net change. What most people don't price well, which we talk about in the book, is that volatility path. How many times did the market go from high to low to high to low to high to low, all right? And you can discover opportunities from looking at that. That was one of the methodologies I used, was not finding mispricings of vol, because like I said, if you simply went long vol and held, you got freaking crushed, okay?
Relentlessly.
You got crushed. However, if you're in a market where you have predetermined price targets, and again, I'm saying this, and I did this walking forward, and I'm saying this in hindsight now, so I appreciate the frustration from people, but it's just an example of, it can't simply be, if you're gonna be successful, I'm gonna do this, and that's it. You have to spend a lot of time analyzing your own P&L attribution. What's making me money right now? What's the narrative behind why that's making money? And that process of self-discovery is what's important. We're all frustrated with the market, okay? I'm very excited about 2017. I think, there's no doubt about the last 2 years were very frustrating. I still managed to make money, still did okay. But to me, if during that time you weren't analyzing your P&L, if during that time you didn't have a list of which strategies were performing and what the macro catalysts were that can change things and put you in a different direction, you're probably doing a disservice to yourself. And so this book gives the processes from all the contributing authors to analyze that and say, okay, was I actually measuring performance on a return per unit of risk basis? Or was I simply measuring it from a nominal basis? Because on a return per unit of risk basis, let's talk about 2016, okay? In 2016, the Sharpe ratio of the S&P 500 came out at 0.97, all right? Now, I think the Sharpe ratio is great and instructive, but it has some limitations. The Netto number of the S&P was actually 0.97. But let's look at gold. The Sharpe ratio of gold in 2016 was 0.43. The Netto number of gold was 1.2. Now, the Netto number works similar to the Sharpe ratio in that the higher the Netto number, the better the risk-adjusted performance, and vice versa. What I think is performance, what's important is we need to analyze performance from the context of a risk budget. And if you're analyzing strategies, the macro narrative, from the context of which market, which strategy, which manager is performing best on a return per unit of risk basis, the opportunities you see will be markedly different.
Well, let's talk about that, because the Netto number is an idea that I'd like you to flesh out.
Absolutely.
And this is a great example, the S&P and gold, because at the end of the year, gold was up 8.5%, I think, and the S&P was up 9.5%, I think.
Right.
So the disparity between those. So let's talk about what the Netto number is, how you come to it, and then perhaps you can walk us back through those two examples and explain the disparity.
I would love to, sure. The Netto number, I define three dimensions of performance analysis, okay? The first dimension of performance analysis is simply saying what the market was up. The S&P was up 9% on the year, like you just talked about, okay? The second dimension is to apply the performance relative to that volatility that went on, which is what the Sharpe ratio, the Sortino ratio, the Kalmar, those institutional metrics that you see on a manager tear sheet. The third dimension is to measure the performance relative to a predetermined risk budget. This is something that is not done on an institutional level, and it tells you a great deal and can save so much agony and so much pain if people did this. So let's give an example of the S&P, all right? There are many ways you can derive a risk budget, but we'll look at the S&P and go from there. If the average annual range of the S&P in the previous 4 years, and this is a very vanilla example, there's much more complex ways, is 12%, okay? I will take half of that 12%, okay, and use that in the denominator. And I'm going to try and avoid going too mathematical because it's hard to envision that. But basically, we now have context of what might be the theoretical risk budget of the S&P 500, okay? Well, the S&P 500 started, and so the second factor, I apologize, let me just reset it for a second. The second factor is, okay, I now know what was actually at risk. Now let's measure the volatility, because what the Sharpe and Sortino and the Kalmar do is very important. You have to have volatility and context to what performance is, along with the risk budget. So I built the Netto number so that the denominator is equally weighted between what the actual risk was and what the volatility was, okay? Well, guess what? The downside volatility of the S&P 500, it was down more than 10% at one point in time last year. Guess what the downside volatility on gold was, meaning it's down from the open? 0. Gold opened the year and shot straight up, okay? And gold actually reached its risk budget. So the way the Netto number works, I give gold a 0 penalty for volatility because all the volatility in gold went on the way up, and its risk budget was $160, okay, based on half of its average annual 3 years of ranges. And this is rough in estimates. I don't have the numbers in front of me. But the bottom line is, given that metric of using an actual risk budget with gold and only counting downside volatility against it, the Netto number on gold was 1.12. The Netto number on the S&P was, the Sharpe ratio on gold was 0.43. So the Netto number on gold was 4 times stronger than the Sharpe ratio on gold.
Right, but people, this is fascinating because people are going to be sitting there, anyone who trades gold is going to be sitting at home saying, 0 volatility on gold, are you out of your mind?
Zero downside volatility.
No, exactly.
Yeah,
But people instinctively understand gold to be among the most volatile asset classes out there. And certainly if you look at the round trip it's taken this year, it would suggest that to be true. So I'm fascinated by this new way of looking at it. To your point, explain how that works for people that want to try and reconcile the low number and the high number.
Sure, and that reconciliation happens on a temporal basis, on a time basis. I was giving you an example of all of 2016.
Yeah.
Because the reality is, Grant, and you and I know this, the real world, the asset management world, the active trader world is freaking path dependent. Yeah. We are path dependent people. When you start me off down in a position, like the S&P started off down in a position, okay, for that time, okay, that path really matters. Because if you're down 10% in a position, all right, and you've almost reached your downside annual vol, you're going to manage the position much differently if you have a real risk budget in place, okay? And the problem people get into, all right, is a temporal one. So if you want to make the case against gold, let's throw a Netto number on gold for the last 6 months, because now I can flip the script the other way around, okay? And now for the last 6 months, the S&P's Netto number is much higher than what gold's is, and gold's is much worse because gold's is almost all downside vol against it, and you have a much different story. So guess what? Use this and other unit of risk ratios to measure the true return per unit of risk of a market over that respective time frame, and it tells you a much different story about the macro narrative. And when you have these innovative ratios to help you measure and put this into play, it changes the game of what you can do.
Well, we're seeing a change along these lines in terms of how hedge funds, for example, are getting paid. And that's arguably long overdue. So something like this comes along, the Netto number, and this idea of return per risk unit, that kind of upsets the apple cart a little bit, right? I mean, that is a whole new way of thinking that actually seems to be gaining some traction in the industry. Are you seeing that?
Yeah, actually there's a CTA out of Chicago. One of the contributing authors, they started with 5 million in AUM in Q3 of 2014. They have 220 million of AUM right now. Beginning Q2, they're going to have a Netto number risk factor compensation system in place for their investors. People want to pay for unit of risk for a number of reasons. They want to pay for alpha without overpaying for beta. It's a common theme out there. And what this does is, when you begin to pay on a return per unit of risk basis, you have managers and investors working together, okay? I love the fact that a manager can make 40% incentive fee or only make 6. I love the fact that a manager can have 50 million in AUM and make as much in an incentive fee as a manager with 500 million in AUM because his return per unit of risk and the value he provided was there. And the last thing we do in this book, we talk about the implementation phase, is 1, lay out how the Netto number equally weights the 2 most important things that I construe is 1, how much capital is actually at risk, and 2, the volatility around those returns, and then 2, a scale based on what you pay a manager. So if I give you, Grant, $1 million to trade and say, hey, you have a $200,000 risk budget, okay? Meaning if your account goes from $1 million to $800,000, you're done, you're stopped out. I give manager B over here $1 million and say, you can lose $500,000. At the end of the year, you're up 10%, he's up 10%, you have the same vol, your return per unit of risk was 2.5 times better than his. Why aren't we measuring performance in that way?
But have you had, I mean, I guess you must have had pushback when you talk about this, because obviously there are interests at stake here, and the industry has fought long and hard against reducing fees. It's starting to now happen really, really quickly, which is understandable given what we touched upon earlier and the poor performance that really good managers have seen. Is this now, you think, going to continue? Is this?
Here's the great part about this. I think reducing fees for the sake of reducing fees is the wrong answer. I think putting in place a dynamic, robust compensation framework that actually pays managers when they deliver much more than 20% if that's truly the case, and much less when that's the case, is the right answer. Because when you lower fees, you're simply being reactive. We want something that's proactive and dynamic. We want to show people that the 2010s was the decade that we ushered in not only how we assessed investment skill, which I think the Netto number does, but also what we paid for it. I want people to look back to the 2010s and say, wow, you mean they didn't do it this way before? They didn't pay on a return per unit of risk basis before? How did that not happen?
So I want to go back to, you talked about 2017 and how optimistic you were about this coming year.
Yes.
So let's understand the basis for that optimism.
Sure. A lot of it begins with, I think that we are leaving a regime, or we are exiting a regime of central bank control, and we're getting back to the economic data. We're getting back more to the narratives. I think the Trump presidency, this populist movement we saw in 2016 has some really positive implications for us for volatility and for us as traders. We're looking at, I think we can see a lot of moves in commodities. I like copper to give us a lot of movement. I like crude to give us a lot of movement. I think that We can see a nice range in bonds this year, nice range in 10 years. In the short term, probably see more of a flattening yield curve, meaning 2s and 10s are weaker, 30s are stronger. So we flatten in that regard. And that's going to create a lot of back and forth. I think also we've reached an inflection point in the economic data. Just again, this is my own stuff, but it's very fluid, it's very protean, and I'm not sure the evergreen extent of where this is at. But all of this portends very well for, if not more volatility, more gamma. And as I talked about the most profitable strategy in 2015, if you recognize that, okay, on a net change basis, the S&P didn't go anywhere, but there were very specific gamma opportunities that allowed you to isolate volatility on an hourly, daily, or 2-day basis that when extrapolated out, gave you those kind of opportunities with the right sizing. Now, that all sounds easy in hindsight, but what I mean is that may be the market that we're in, and you have to accept the fact that, okay, from a temporal basis, I may need to be a 36-hour trader in order to capitalize on that, using these macro themes that go through very cyclical and structural cycles.
It's interesting because you talk about optimism and you talk about the things that you as a trader are optimistic about. Many investors are going to be sitting there just terrified about 2017 because with populism, with change comes volatility.
Yes.
With the lessening of central bank control over markets comes uncertainty.
Yes.
These are all things that are great for traders.
Yes.
And terrible for investors.
So but I don't know that because investing inherently is about finding opportunity and about finding price discovery.
I agree, but the one thing that I've seen happen almost as relentlessly as volatility getting crushed is the ability to invest within a given time frame gets shortened and shortened and shortened. And now investors can't invest anymore. It seems, unless you've got a really specific set of investors who are happy to give you that latitude.
Right.
Investors, if you're looking at beginning of 2017, trying to invest on a 1-year basis even.
Right.
You're going to be sitting there tearing your hair out because as we stand here, you have no idea what's going to happen. Whereas for guys like yourself, traders that have that
idiosyncratic understanding of
you're talking about 36-hour trades, right? You're right. This is going to be a fantastic environment for traders because of exactly the points you made. And I think people need to understand, first and foremost, what are you? Are you trying to invest or are you trying to trade here?
Well, I think the process of identifying whatever the time frame is, an investment on a return per unit of risk basis is very scalable and very applicable to investors, to money managers, and to third-party advisors and consultants, which is what this book was written for. So that aspect has a transferability to it that goes to everyone. At whatever time frame you operate on, you need to have a process in place to not only assess the strategies that you're investing in, but understand the risk controls around them. I think we can all agree on that.
Yeah.
That investing on a risk budget is not a day-to-day thing. It's not, I have a stop on this trade, but what's the stop on your money manager? And have you decided that before the fact or after the fact? Or are you the type of investor that gives a guy, a great macro manager, an investment, tells him that you can take on all this risk, and then 6 months later, when the guy's flat following his plan, actually you can't take on so much risk. And you didn't have a risk budget in place. And you said, yeah, I can lose 15%, and you're down 1, or you're up 1. And all of a sudden you pull it out, and my time frame's 2 years, and it's actually only 6 months. That's what causes wealth destruction.
I could not agree with you more. But not only does it cause wealth destruction, it's wholly understandable why it's happening. And I've seen nothing to suggest that it's going to change anytime soon. I just haven't seen that.
So then let's embrace that.
Yeah.
That's the environment that we're in. We're in an environment where where allocators are fickle, okay? So that means there's an opportunity. If they're not investing their capital in the wisest ways with the best managers, that means that there's opportunity for inefficiency out there. And I'm saying that as a guy who has succeeded in that kind of an environment over the last 6 years, as the track record proves. This is an environment where, okay, this fund follows their mandate, follows their plan, performs in single digits, investors get frustrated, they pull capital, they follow someone else they think is going to go, that's going to be hot. You got to be aware of that. This is the environment that we're in, so adapt to it or watch and wait till it becomes the environment that you are more comfortable in. I'm comfortable in this environment.
And a lot of people are, but I think the problem has been that people were more shaken up by 08 than they realize.
Sure.
And I think on the one side, they instinctively feel something's still not right.
Sure.
And that doesn't get rid of the fear. And so it's not just allocators that are fickle, it's investors who are fickle, it's traders who are fickle. And trying to get the mental fortitude to resist those fickle urges it's really tough to do. Only good traders are able to do that, I think.
And I would say to those people who are fickle, okay, it's your job to take on risk. And that's what a risk budget is for. Have the conversation with that manager when you give that allocation. Okay, and it's not just about vol targeting, because vol targeting is what gives you your excuse after the fact when things don't work out, okay? Vol targeting is not a stop loss. Vol targeting is an attempt to put together a portfolio of non-correlated strategies and ideally estimate what the potential ranges may be. But you need a hard stop, because that concern you talk about, that fear you talk about, the conversation needs to happen between managers and investors about what that risk budget is. And then once they both can agree and truly understand that that's where the investor's comfortable, I think a lot of that anxiety eases, because now you've defined your risk. It's not defining your risk to me that causes a lot of anxiety, and the fact that one manager, or we get this big market meltdown. Well, if you have strategies in place that follow a risk budget, that should alleviate some of that anxiety, because, okay, I've defined my risk, so let's now go on with our lives.
Yeah. Well, look, John, unfortunately we've run out of time, but look, I think we should maybe come back mid-year and let's take a look at this, because I think this is something that's going to play out, it's going to evolve, and people are going to be able to look at this book, and we'll put this up so people can see the book and contact you and find out more about it. But let's do this again in 6 months and just evaluate how things have changed, because I think this is going to be a story that continues to build momentum through the year.
Absolutely. Thank you so much, Grant.
Thanks for coming.
All right.